Today, I'd like to discuss how to maximize the cash value of a life insurance policy, specifically focusing on the design. Now, we often talk about policy design, where your money can go, base premium dollars, PUA dollars. We're not going to go through all the mechanics like we do in almost every video on our YouTube channel. What we're going to talk about today, we're going to answer a question, and the question is this. If I, as a policyholder, if this is you, take less money up front, does that mean I will have more money long term? Or does it mean that I should have more money long term? If you ever talk to an agent about this, you may have heard this, you may not have heard this, that if you go with a policy that has a higher base premium, less money going toward that PUA rider, which maximizes the cash value, more money going toward the base premium, that long term, or I should say immediately, you will have less money. However, long term, you should have more money. You will very, very rarely hear any agent or financial services professional state, you will have more money long term. It'll always be should, because there's a lot of variables there. Depends on the insurance company we select, and also the dividend rate. There's a lot that goes into it, which we'll hit on today. So, before we get into illustrations, because we're going to look at illustrations that actually show more cash value long term if you take less up front. But before I just jump into the illustrations like I sometimes do, let's begin with an exercise. If I said to you, hey, I've got this special account that I can guarantee it'll go nowhere but up over time, there's no risk. If you give me $100,000, I guarantee to grow it. However, I have two different options that are available. I've got option A and option B. Both, let's assume you give me $100,000. With option A, in the first year, if you give me $100,000, you will have access to $90,000. Your money is going to go to work, but what you can actually access of your initial payment is $90,000. Sound good? Okay, and you have life insurance, by the way, as well. Now, 10 years later, your $100,000 payment, that is the account value, is now $200,000. This is the amount of money that you have access to. As time continues to pass, 20 years down the road, you've got $300,000. And then 30 years down the road, you've got $500,000. So that's option A. How's that sound? Not bad. Then I've got option B. And I say to you, if you give me the same $100,000, we can put it in this different account. And here's what this account looks like. Year one, you won't have access to $90,000. You'll only have access to $40,000. Year 10 years down the road, you'll have access to about $150,000. So the value has appreciated over time. However, in both examples, we're assuming you gave me just $100,000. Option A, by year 10, you had $200,000. And option B, by year 10, you've got $150,000. Option B, year 20, you're at $280,000. Getting close to option A. And then in option B at year 30, you've got $600,000, $100,000 more than option A. Which option would you choose? Now, the answer will vary depending on who we speak with. Some people who don't plan on touching the money would select option B. A lot of business owners, entrepreneurs, real estate investors will select option A in a heartbeat because they want access to more capital up front for opportunities. Here's the thing though. See that in red? Kind of small. I did that on purpose. So in red, we've got a disclaimer there that says, look at the guarantees. However, because the fine print is very small, most people do not ask the guarantees. And I'm not always quick to show them. In my actual practice, we are, but in this exercise, I'm not. So let's continue this exercise. Let's look at the guarantees. So option A and option B, what we looked at first, that's based on if everything does exactly what it's supposed to, meaning what I think I can produce for you, those are the values that you'll have. However, when we look at what's guaranteed, let's assume the same $100,000 payment. Year one, you won't have $90,000 available. You have close to it, you'll have $85,000. Year 10, $130,000. So you gave me that initial $100,000. Now you've got $130,000 10 years later. Year 20, $220,000. And then year 30, you've got $300,000. Not nearly as much as option A based on what I think I can produce for you, but based on what I'm guaranteeing for you. just comparing option A to option A. They're the same thing. Guaranteed just represents more of a worst case scenario, what I know I can deliver no matter what. Option B, same $100,000. What's guaranteed is not the $40,000, $30,000 is guaranteed. Year 10, $80,000 is guaranteed. You still don't have your 100K back. Year 20, $150,000 is guaranteed. And then year 30, $200,000 is guaranteed. Looking at the guaranteed assumptions, which one would you select? Well, that one's a bit of a no-brainer. It's interesting when we look at a life insurance illustration and what is guaranteed and what is not guaranteed. Now, the unseen element that is very important to look at here is historical data. So if we were to take this same situation, or let me back up and say historical data of life insurance policies, examining the cash value and what has actually happened over time, not just a projection, option A has always delivered greater results, not based on projections, but actual data. We hit on that a little bit in our last video. The wealthy pick option A. Corporations who select this product use option A. Here's something else, though, that's not always disclosed. Me, the agent, option A, which historically has delivered greater results. It guarantees you more money. It also guarantees me much less money. I make $3,000 off of that transaction. Whereas if you select option B, because you take the potential of having more money long-term, keep in mind I said potential, and I have not seen it ever proven out, I make $10,000. So as a consumer, my belief is you should be shown really all options so you can make the choice for yourself. But being shown the options is something that does not always exist in any industry for that matter. And sometimes it's overwhelming, but then sometimes it's not. They're just not shown. This is where buyer's remorse comes into play. So let's take a look at some illustrations and actually demonstrate this with cash value life insurance. Now, the numbers will look a little bit different. What we're going to look at is a policy with $100,000 per year going in. And let's simplify this and just look at two options here. So as we take a look, blow this up a little bit as well. Beautiful. So on the left, we've got a policy that has a 100% base premium. So when we discuss where your money can go, where can it go? We've got $100,000 per year going into the policy here. Money can be directed toward the insurance premium or toward our PUA rider. The product we're looking at here is a policy. There's a great option to maximize cash value. It's what's called a 10-pay product. That means you can pay into it for a maximum of 10 years. This is specifically a whole life insurance product. Premium dollars with a 10-pay product will typically deliver 30 to 35%. Some companies, you'll see 40% of the premium show up in cash value in the first year. Beginning the second year, you get more and more back. But if it's 30% and your premium is $100,000, that means it's a 70% loss in the first year, assuming your goal is cash value. You want to maximize the cash value. So the example on the far left, again, 100% base premium. That means the $100,000 per year, this is on a 35-year-old male, paying in $100K per year for 10 years goes in. First year, $100K payment, all premium. There's his cash value. And this is based on the current assumptions. Option A, not the guarantees. So $36,000 in change. We do have a dividend payout there. As time passes, I see just about by year 8, I've recaptured my money. By year 9, I've paid in a total of $900,000 and I have $933,000. So I now have a gain on my total payments. And after year 10, I don't pay anything in. I've paid in $1 million. I've got a little under $1.1 million. Versus the option on the right. So this would be option B, and this is a 10/90 split. So what that means is of the $100,000 going into the policy, we've got a $10,000 base premium. We do have a term insurance rider attached as well. That helps with our MEC testing, so we don't trigger a taxable event. Remember the benefits, we haven't talked about that in this video, the core benefits of a cash value policy. Safe, liquid, and tax-free if I don't trigger a taxable event, such as a MEC, a modified endowment contract. So the purpose of a term rider is to prevent the MEC. But to get back on track, 100K goes in immediately, almost 90% available, 89.7. So again, we mentioned earlier, business owners, real estate investors almost always gravitate toward, this would be option A actually, the one with more cash value, simply because it's there, available for them to take advantage of other opportunities. When do I recapture my capital? Year 4 instead of year 9. We could argue year 8 because we're very close at that point in time. Year 10, you've paid in a total of $1 million. You're close to $1.2 million. So 10 years in, you've got significantly more money. Now, when we looked at the options, going back to the whiteboard, let me do that actually. What do we notice over here? So I've got these flip-flopped, but that's okay. In this particular example, option B would actually be the example on the left on the Excel spreadsheet when we go back to that. If we look at it long term, so this was 30 years, we're going to go down 50 years. Long term, the option with less money up front gave you more long term, just using the hypothetical example. Let's go back to the actual comparison. These are policies we pulled directly from the illustration, like we always do. Our last video actually went through the illustrations. But here we go. As time passes, what do we notice? So I just want to go down. I'm going to put year 30 at the top, and this will illustrate what I want. Year 30. This was the example with less upfront on the left. This would be option B. Almost at $3.1 million, $3,090,000. Compared to the option where you had 90% upfront and broke even year 4, $3.145. So you've got more money based on this projection for the first 30 years. If we look further down, I said 50 years, we're going to look at 40. So we're going on 75 or 74 years old here, $5.117 million. Compared to this guy, where we had more up front, we're at $5,084,000. So we've got a little bit less cash value in that example there. And as time passes, you'll see this guy, which had significantly less money up front, have more and more long term. We are getting up there in age. I started this on a 35-year-old individual on purpose, demonstrate the long-term benefits. There we go. It's close to a $200,000 difference by the time I hit age 84, almost 85. So which one would you select? Well, again, depending on your mindset and what your intentions are of using the policy, you might say, hey, I like the long-term option here because I do see more value long-term. But what if I said, hey, when we look at the guarantees, it tells a different story? And then what if I also said, this does show more long-term, but we've never seen it actually happen? Because these are all non-guaranteed figures. They both are. But we see this under-deliver more when we have a higher base premium, just based on history with different insurance companies and products. Let's take a look at the guarantees. So same thing here, or same product. Let me get rid of that middle option just to simplify a bit here. That's that. Good. So same company, same product, same everything, but we've got the guarantees. Base premium, nothing going toward PUAs. Here we go. $33,000 right off the bat, less than the $36,000 in the other example. When we look at the policy with the minimum premium, the minimum insurance expense, just about $87,000 right off the bat. Now, as time passes, what do we notice here? When is your break-even point? When you actually recapture your $1 million in this example, because you paid in $1 million for 10 years. What do we see here? Just about year 20, guaranteed $997,000. $997,000, or you've paid in $1 million. Versus the example on the right, when's your break even? Between years 13 and 14. So you're guaranteed to get your money back quicker. Well, the non-guarantees look much better. We're with one of the major mutual companies, which have always delivered very strong results. Now, let's go down to year 40 to 50 like we did in the last example. Because based on what was not guaranteed, the example where you take less up front did have more long-term with this particular insurance company. So I'm going to hit on a very important point right after we conclude this sheet here. Here's year 50, 1.507 versus over here, just about 1.7. You're close to a $200,000 difference, like the non-guarantees, but it's flipped. The example where we had that minimum insurance premium right off the bat. It's interesting, isn't it? Now all of a sudden, which one do I want to select? Well, I need to look at history and some actual performance over time. How have dividends actually been applied to my policy? Because we hit on this in the last video, but why the higher premium example produces stronger long-term results is you'll see the dividend column here is higher over time when we compare it with the low premium policy. That has to do with how dividends are applied to base premium dollars and PUA dollars on an illustration. Actual performance can vary, and it often does vary from what I've seen with a variety of insurance companies. So before we look at the next company, this was all with Mass Mutual here, one of the major mutuals. The example where we had less money up front, let me do the same thing here just to condense a bit. There we go. And this is where it's important that you see both or you are presented both, because often this kind of stuff is not disclosed and people find out about it after the fact. Compensation breakdown, example with the 100% base premium policy, 100K in, cash value, annual compensation. This displays what the agent, if this was me writing the policy, what I would earn each year. And then the total compensation tallies everything together. And this is based on our payout rates, which we've grown over time, so we're at a higher level. If you're an agent watching this and you're new in the business, you're likely not at these levels, but you will get there over time as long as you continue to put the time in. But these are near the top rates. Just so if you're a consumer looking at this, what's like the total rate? Because sometimes agents will show just the base rate, not additional bonus commissions and such that they get. I used to do that years ago. I'm like, you know what? We should show the full rate just to be more transparent. So here we go. That's the annual compensation. First year is typically the heaviest with life insurance products. There's the total, about $78,000. Compared to the example where you're guaranteed to have more money from start to finish, guaranteed to have more money up front, and based on historical data, illustrations aside, we've seen greater long-term results. Check this out. It's a big motivator, just from speaking with agents over the years, that is. Huge difference there when I look at the actual compensation. That was with one company where we could make the argument that potentially long-term, taking less upfront will result in more long-term. Want to look at the same product, the 10-pay product with a different company? Let's take a look. So we've got a couple different designs there. I'm going to simplify this again. And what I'm going to do here, just to save time as we progress through everything, is just condense all three of them. So, different life insurance company, same 10-pay product, which is a product that has a low guaranteed rate and maximizes the overall cash value on the non-guarantees. And it's really the only one, like we looked at with Mass Mutual, one of the few, I should say, that does project greater long-term results with a higher premium. In reality, we don't see it. I haven't seen it with any policies when we look at an apples-to-apples comparison. All premium, just like the last example. Year 10, $1,092,000. Compared to over here, this isn't a 1090, a 2080. The reason why is Guardian's 10-pay product will not allow us to illustrate a 1090 split. We often talk about Guardian where they'll allow us to illustrate 10x the base premium and PUAs per year. With the 10-pay product, that's the one exception where the maximum PUA you can illustrate each year is 5x on top of the base premium, not 10x. With the exception of year one where it's that 50x. But here, we still see a significant difference. You're about 81% compared to the all base premium policy, 40% or 41%. As time passes, what do you notice here? Not quite the same as what we saw with Mass Mutual, was it? No. You're higher at year 10. Let's go all the way down to years 40 to 50, like we did in the last example, and tell me if you see a difference. The example that had more up front has close to $400,000 more by year 50. So more from start to finish, no argument whatsoever. Different company, where the dividend rates aren't that much different. Got Guardian at 5.65%, Mass Mutual at 6%. And I've said before, we've seen Mass, Guardian, Northwestern, and New York Life always go back and forth with each other. Hard to say one company is better than another when we look at actual data. But these are based on the present dividend interest rate. Then we've got the guarantees. Let's take a look here. One more click. Beautiful. So based on the guarantees, what do you see? First year cash value, same thing. When's your break-even point? I didn't highlight the break-even point in the last example. Sorry. With the all-base premium policy, based on the dividend rate, year 8, and then with the max blend, minimum premium between years 5 and 6. Based on the guarantees, when do you hit that $1 million mark? The high cash value policy, year 12. The all insurance premium policy, year 15. Scroll down, you see a difference. Oh yes. Year 50, you notice. 1.67 compared to 1.737. So closer in the guarantees actually, but still more money from start to finish with the low compensation product. Let's do the same thing here. Guardian's 10-pay. Really reduced compensation compared to what it used to be. Just when I say used to be before, the 7702 change and reduction in guarantees. But here we go. Can I go another click? Yes, we can. So, what do you notice? Similar trend, right? The high insurance premium policy, 88, almost 89,000. And the high PUA policy, about $44,000. And these are pulled, like they always are, directly from life insurance illustrations. Right, so if we look at the Guardian examples, there's one. That's the all premium policy. See everything match up, guaranteed and non-guaranteed. In fact, there's the guaranteed and non-guaranteed values. And there we go. All right, pulled from the full illustration like they always are. So a lot of info there. The main point is whenever you're looking or considering a high cash value life insurance policy, it is important to really see all the details or be aware of them. Make sure that you're doing that or someone is doing it for you. Could be your agent, could be a third-party advisor, could be someone that has experience with cash value life insurance, whatever it might be. It's very important to do that. This way, we don't select an option where we have less upfront, expecting more long-term, but then it doesn't deliver. And if we could rewind the clock, we would say, I would have went with a different option, but it was never shown to me, or this additional detail was not disclosed. The disclaimer, look at the guarantees, was never shown. Historical performance was never shown. All of this important information was never shown. We've got to see that information up front. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. It does help us. And feel free to leave a comment below. I'll reach out with any questions. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.